Big winner in the Dow today was Disney. Very interesting one this week. Disney was up more than 2% today. General Electric, the decliner, the laggard, down nearly 2%. Over in the S&P, Twitter, once again, the big winner. It has repeatedly done this since being added to that average. It's up more than 6% today, trading at nearly $47 a share on the close. Mylan, though, was down about 5%. Mike, real quickly, what is this Disney move telling us about what's happening with these media deals?
I mean, obviously, depressed valuations coming into this whole bidding war, so I think Comcast and Disney, if you didn't like the idea of them bidding a big number for the Fox assets, you probably sold the stock already. So right now, it's about two relatively rational, fairly disciplined companies trying to figure out the right price to pay for what everyone agrees is a valuable asset. So I think the idea that it's not going to be a complete free-for-all, and the stocks already had come down a lot. You have both companies out there also saying, look, this is why it would work for us. It's getting a receptive response, I think, for some of the market.
Disney's not going up because people think they're not going to
I don't think so. I don't think it's going up because people are writing off. But you have to raise the probability that Disney does not end up with Fox because you have a superior bid on the table right now.
And look at Comcast today. It was up 4.5% for its part, having a nice session. So it's
at about a more than 3-year low in valuation for Comcast based on current cash flow. So I do think, again, it's coming from a level where people think a lot of the risk has come out of the core valuation right now.
Flip side of that, Nancy, is it was also a strong day in tech. Tech, I think, was close to an all-time high today. Consumer discretionary, which has Netflix and Amazon in the basket, same kind of story. So though that sector had been a little bit more weak lately, and now it's kind of finding its footing again.
Yeah, I think investors are stretching for growth now. The LEIs, the leading economic indicators, flipped over recently, and you see them reaching out for growth. I mean, there are days when Google and Facebook are up on bad news. So
we're talking about maybe a 4% or upwards GDP quarter.
Yeah, absolutely.
Do people have to reach for growth? Can't they just turn around? Isn't it to be found on every quarter right now?
Yeah, but the GDP growth is reflective of 69% of the economy driven by consumers. So I think we're at earnings peaks, potentially, or soon to be, and that's one of the things that has investors reaching, I would say.
That makes sense. To that point this morning, the retail sales number, very strong. This is one of the reasons why those growth forecasts started to go up. It was up 0.8%. This morning. That was versus an expected increase of just 0.4%. Biggest advance since November. We had Etsy, which you mentioned a moment ago, up nearly 30% today. That kind of its own issue. We had a spate of different retailers. It wasn't just, a Netflix and Amazon story for consumer discretionary. We had a lot of the retail sector doing quite well. What is that telling us?
Yeah, I mean, look, in the short term, I can't really answer that. In the long term, I think it's telling us that valuations had moved too far in the other direction, that the consumer is well heeled and debt is manageable, and that, just like with Disney and some of the media companies, like Comcast finally had a good day, right? I don't know if you can laugh at that.
I know, we can absolutely, we can basically only chuckle at our own
expense. Let's be honest, you did have a rush of a little bit of wage growth, and you did have a pretty good tax refund season, and that all filtered the way through. So it's not as if people are saying we are now in a 4% run rate indefinitely, but this was definitely a good period for consumers.
Burns, some of the numbers we got today, so especially after the retail sales report, JP Morgan took its GDP forecast up to 4% from 2.75%. Amherst is just under 5%. Macroeconomic Advisors is at 4.4%. I mean, these are so, that's a strong read. I guess the question is it sustainable?
Well, in the near term, it certainly should be. I mean, the consumer figures are reflective of the fact that consumer balance sheets are extremely strong right now. Consumer confidence is also at high levels. And with the tax cut, what it demonstrates is that consumers are spending that tax cut. And one thing that actually I think would make it sustainable is that a lot of the lower end consumers probably aren't going to feel the benefits of the tax cut until 2019. And so that's something that might actually stretch this out a bit.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.